Welcome to part 2 of this ITC video class for IFRS 16. So in part 1 we looked at how do you identify lease contract, and for this part 2 we now want to focus on the accounting part of it, but specifically looking at the... Okay, so let's begin. If you are the lessee and you've concluded that there is a lease transaction which is here, it qualifies to be called a lease contract, then your recognition, let's start by your recognition. So what you recognize is you recognize a right of use asset and a lease liability. This you already know, except where there are two exceptions to recognizing of a right of use asset. The first exception is if it's a contract which is for a period of less than 12 months, which we call a short-term lease, then you are allowed to be exempted from raising a right of use asset, which means you simply raise an expense for that particular contract in the year that you've actually expended. Then the second one is if it's a lease of a low value item, then you are also exempted from actually raising a right of use asset. For low value items, you also just expense, you kind of like treat it as an operating lease, where the payments will simply be uniform throughout the lease period. Okay, so those are the two. Now, in terms of will you be expected to make a judgment of whether this is a low value lease contract? I don't think so. I think it will be specifically given in the examination that this is a low value in the event that they want you to apply the concept related to this exemption. All right, great. So that is about the recognition. I think the recognition is quite straightforward for you guys. Okay. The measurement is a bit, this is the part that I want to spend a little bit of time on. So we said you got a right of use asset and you got a lease liability. I'll start by how do you measure the lease liability? So the lease liability is measured by present valuing the minimum lease payments that the lessee is expected to make to the lessor. And the minimum lease payments include the following. It includes those payments which you've guaranteed to make during the lease period. And it includes the annual or monthly lease payments, which we usually call the rentals. So this is the one that we usually put under PMT here. Those lease payments which you make over time, the series of payments which you make over time. So those ones will contribute to the lease liability. We also have lease contracts where the lessee guarantees that I will give you a certain amount of money at the end of the lease period, which we usually call the guaranteed residual value. So all of those amounts which the lessee would have guaranteed are also supposed to form part of your lease payment, and we put them as the future value. Now, these two payments are the minimum lease payments which can be made by the lessee. So they constitute the lease liability. But we need to present value them to today. So we present value them over the period, the lease period, which we reflect as N year. And they need to be discounted. And the discount rate that we use is defined as the implicit interest rate, which is that interest rate which will discount the payments related to made by the lessee and those ones which they may not have guaranteed to equate the fair value of the asset today. We'll talk more about the implicit interest rate later on in a few minutes' time. Okay. So when you present value this one and this one, they will then give you the lease liability today. Now, I need you to watch out for variability of the lease payments, because that is one area where students usually do not take a lot of time to look at. So I need you to go to paragraph 27 of IFRS 16. So 27A, B, and C covers your lease payments, and your A has got the fixed ones, and your B and C has got those ones which are variable in nature. Okay. So when you've got a variable lease payment, or variable lease payments, we usually include them if the variability is based on an index or a rate that we actually use to reflect the changes of the variability. Okay, so that is when we include them. And at the point when it varies within the necessary adjustments. But we also have got those variabilities which are caused by some uncertain future events which are beyond our control, which we do not include on day one, on the date that we enter into the list, but we wait for the event to occur. When the variation changes, we then make adjustments at that particular point in time when the variation occurs. Okay, so watch out for variable lease payments. Look for some questions to do which is with variable lease payments, because I think this is important for you to understand before you get into the examinations, especially in January. Then we talked about you need to discount this over the lease term. Pay special attention to what exactly do we call the lease term. So the standard explains the lease term is the non-cancelable period plus the period which is covered by the option to extend. So when you are given an option to extend, we actually need to look at the option and see if that option should be part of the lease term. And that option is only going to be part of if it is reasonably certain that we will take the option. Now, how do you know if it's reasonably certain that the option will be exercised? Well, you look at, is there an economic incentive for me to continue with the lease contract into the period of the option? So let's say we agreed that I'm going to rent for 2 years with an option to extend for another year to make it 3 years. Why would I take the additional third year? It's only if there is an economic incentive. So if it's a discussion question, bring out the why. Bring out the reason why you say this third year will be taken. What are the reasons behind? They need to be clearly coming out. Not simply to say there's 2 years and there's an option for a third year and we think it's highly probable that it will be exercised. Full stop, therefore the lease period is 3 years. You get 1 mark if you do that. Drill down, give more explanation about what you mean. Okay. Talk about that implicit interest rate that we talked about. So when you go to the appendix section of IFRS 16, Appendix A, it gives you the definitions. One of the definitions which is given is that of the implicit interest rate, which is basically the interest rate which present values the lease payments, which we've already talked about. The lease payments are the guaranteed residual value and the ones which are made per annum or per month, the series ones. Okay, so the one which present value is that one, plus the unguaranteed one, the one which the lessee is not taking to be theirs. The two should be present value to equate the fair value of the underlying asset, plus any direct cost which have been incurred by the lessor. But in practice, it will be difficult for the lessee to be able to know what direct cost did the lessor actually incur. Because they're not going to go and say, give me the invoices which relate to this contract which you have incurred so that I can calculate my implicit interest rate. They're not going to divulge that information to you. So in the event that you are not able to calculate the implicit interest rate, then the standard actually allows you to actually use an incremental borrowing cost in that event. But most of the time, for examination purposes, will be given enough information for you to be able to calculate the implicit interest rate. So please be able to do this. It is very important to be able to calculate that. Your lease period, you've got the implicit interest rate. That means you can now actually calculate that lease liability. Now, that's about the lease liability. Let's jump down to how do you measure the right of use asset, which is what we have here. So the right of use asset is measured by taking out that present value of the lease liability that would have calculated. Then you make necessary adjustments to it. And the adjustments which you make are, you need to remove if there are any lease incentives which are there, which are part of those payments which have been made. Because the incentive for you to get into the contract is not part of the cost of the asset. Okay, so you remove any lease incentives, then payments which were made prior to the commencement of the lease. So if there are any payments which were made prior to having the lease contract, then they are also supposed to be excluded. They're not part of the right of use asset. Then you add any initial direct costs which would have been incurred as a result by the lessee to be able to get into the lease contract. Then any restoration obligations if we need at some point to dismantle whatever the asset that we have, or to restore the environment after the lease period, any of that, you know the concept coming from IFRS 16, so it is still applicable there. Okay, so that is the relevant paragraph for you for your reference to. That's how you calculate your right of use asset. So we now have a figure which we've attached to the right of use asset. We've got a figure that we have attached to the lease liability. Now, I am concerned about VAT. You need to watch out for VAT. Okay, so remember, the concept of VAT is if you are a VAT registered vendor, then you have incurred these costs which are inclusive of VAT. In capitalizing those costs to the asset, you are not supposed to include any cost which will be refunded at some point in future by another third party. So when I look at VAT, most of the times when you incur this and you are a VAT registered vendor, the VAT component that you've incurred in order for you to obtain this lease contract and to be able to get the right to use that particular asset, that VAT component will be claimable back from ZIMRA, which means this is kind of like a VAT input kind of thing. The moment you're able to claim it, that means it cannot form part of the right of use asset. So we actually need to exclude all the VAT, which means your journal entry will be kind of looking like you've got a credit of the lease liability over there, you've got a debit of your right of use asset, but this right of use asset will be lower than the lease liability over here, with the difference being the VAT, so that you don't have your VAT being part of this right of use asset. Okay, so that is quite important for you. Okay, now I need you to go to the June 2018 paper and look at the, I think it's paper 2 or paper 3 if I'm not mistaken, which has got a list. Go there, it has got a concept of VAT which is there, which is quite interesting. Now it brings out, that question brings out another important element, which is installment credit agreements, the VAT element to it. So remember, if it's an installment credit agreement, it's being taken as a sale which is simply taking place in installments, which means from a point of view of ZIMRA, that VAT may be claimable upfront. Okay, but I do not want to get too much into detail of that because I'm sure you covered that from a taxation point of view. So you go to your tax and you then find out, now what does it mean if I've got an installment credit arrangement? From a VAT implications, what are then? So from day one, you've debited your right of use asset, you've credited your lease liability, you've debited any VAT components if necessary. Okay. Then let's talk about subsequent. So subsequent, obviously, you're going to amortize your lease liability, and then your right of use asset as well needs to. Let's talk about, we talked about the lease liability calculation having variability at some point in future. So I will need you to be able to understand paragraph 39 to 43. What happens when the inputs we used to calculate the present value of the lease liability on day one suddenly change? So the future value, the one that we guaranteed, changes. What do you do? What if the payments that we have agreed to are then revised? We are in an economy where things are changing. We had agreed on rentals for $450 per month. Then the dollar is deteriorating. So now it then increases to, let's say, double, $800 and something dollars. Now, what does it mean to this contract? Okay. Or the lease period is then extended, where we'd agreed on 3 years, non-cancelable without an option. Now we come and revise it and we make it 10 years. How do you deal with those variabilities which come through as a result of that? So what you do is you recalculate the lease liability using the new discount rate on the particular date when these change. So if it's a period change from 5 years to 7 years, That means there are now extra 2 years which come into play. You need to recalculate the lease liability, now taking into account the remaining number of years, but now using the new discount rate, which will be applicable on that particular date. Okay. But there are 2 exceptions where you do not use the new discount rate, where you actually go back and use the old discount rate. And those 2 exceptions are if it's a change in the residual value, then you stick to the old one. Or if it's a change in the PMT, but as a result of a fixed lease escalation. Okay. The one, for example, which is linked to the index, okay, which we found on paragraph 27B. If it is that kind of change, then you simply go back to use of the original discount rate. So usually we find the fixed lease escalations, they would have been stated in the contract from the inception. So we already knew from the day one that we got into the lease contract that the lease payments are going to vary, and they will vary based on the inflation rate. Which means when the inflation rate then jumps from the 5% that we had in early October to the 20-something% which the government has officially stated, if the lease contract was linked to those escalations, then we recalculate this lease liability based on the shift which happened in the inflation, in the inflation index rate. But we stick to the discount rate being the original one, because this was part of the contract from day one. Okay. Or if the residual value was 5,000, now the residual value is an estimate. This year we reassess the estimates and we now believe that it's no longer 5,000, it's now 8,000. That means we recalculate the lease liability because the original was based on a present value of 5,000. Now we need a present value, not 5,000 but 8,000. Okay. But when we discount that new 8,000, we still discount it based on the original. Any other changes, we stick to the new discount rate on that particular date. Now what happens when you've recalculated, that means you've got an old value of the lease liability which you want to compare to the new value of the lease liability. So when you've got that, the difference between the old value and the new value is 2 ledgers, which is the right of use asset ledger and the lease liability ledger. If the lease liability is increased, it increases the lease liability and increases the right of use asset. If the lease liability has dropped, you debit the lease liability, you credit the right of use asset. I believe the journal entries are quite straightforward for you. Okay. Then let's talk about the tax implications. So the tax implications are also quite important. I need you to be able to calculate the deferred tax mostly for any lease contracts, which means be in a position where you are able to do your DT calculation, where you split, you got your carrying amount, you got your tax base, you got your temporal difference, and you got your deferred tax asset or liability over there. Okay, like that. Okay. So remember, if it's a right of use asset, you're gonna get your carrying amount over there, but ZIMRA has no idea what that is, what a right of use asset is. So that means your tax base is gonna be new over here, which makes the full amount a temporal difference here. Then you multiply by the relevant rate to give you a deferred tax here. Then you also have got the lease liability here, which you need to put over there. Then ZIMRA will not know that except if there are any VAT implications which are not which are going to be refunded. Then otherwise you've got a TD and you've got deferred tax over here. If you have raised you might potentially have raised a provision for dismantling costs related to this right of use asset. It also comes here. So you've got a provision for dismantling. Then you got the figure coming there, ZIMRA nil, same wise over there. So I need you to be able to do the deferred tax computations when it comes to lease transactions. Then exemptions, we've talked about the exemptions, the 12-month one. Then lastly, please take note that lease modifications, ladies and gentlemen, are excluded. So you do not need to do the lease modifications that are part of this. Okay, great. So that's accounting for you from the lessee's point of view. I hope you've enjoyed this part. We are now going to the last part of the leases video, which is going to be part 3, where we focus on accounting but from the lessor's point of view. Okay, great. Thank you, ladies and gentlemen.